Bank stocks have become market favorites. Among the larger indexes, it is the Nifty Bank, which looks set to reach all-time highs even before the Nifty. The Nifty PSU Bank Index, surprise, surprise, has done the best. It's gained 6% month to date in September, best performing index. Banks like State Bank, Bank of Baroda, Indian Bank, as well Karur and DCB have all already set fresh 52-week highs in September. And the man who probably started this recent run is my guest today, Ashish Gupta of Credit Suisse, the managing director and the head of research there. Ashish, you were the first to write a report raising the earnings of many banks, including SBI, by 5 to 15% this year. I think September 2nd was that report. And since then, this rally has got some more legs. Of course, it started in mid-June itself. Thank you very much for joining me. Now, my first question is there a possibility of even another level of upgrades, simply because look at the bond markets, in spite of having a higher than expected inflation, today we have lowered the yields have fallen. This bond index thing is looking very imminent now. So even further earnings upgrades can't be ruled out.
Sure. So good morning, Lata. Thanks for having me here today. I think we definitely see that the risk on our earnings estimates are still on the upside. Although I would not peg it to inclusion in the bond index or really gains coming from bond losses being reversed, but more so from operational earnings. I think really in the last 15 years, we haven't seen the outlook for the bank so positive virtually on every front. Whether it is margins, whether it is growth, and of course on asset quality. And I think the bigger drivers of surprise to my mind over the next 6 months will be bank margins as well as credit costs.
Okay. Oh, yes, credit costs. So you're expecting that it can be even better than you put out. So then let me ask the braver question. Does it look like it can get as good as 2003 to 2008? Banks started slowly and then as it is, look at the galloping credit growth. Just the other day, we were in single digits and now 15.5 rushing towards 16% non-food credit. We had gone even to 25 in the previous round. You think that we are somewhere like the 2003 growth pace?
Sure. So I think absolutely in terms of credit costs, we could be in an environment like 2003 to 2007. And this typically happens in every credit cycle, right? You have a period of aggressive provisioning for the banks, and then you get to a period where there is below normalized provisioning. Right. So every credit cycle, you have NPAs coming and provisions, as you recall, in the last couple of years, but as high as 3 to 4% of loans for the banks. And during a credit cycle, actually, banks pull back on lending, they tighten their credit standards, and then you get a period where you get a below normalized credit cost. So I actually believe that over the next 2 years, you will get below normalized credit costs for the banking system. And this will be across the space. It won't just be in private bank, but even state-owned banks, you will see the benefit of low credit costs.
Low credit costs, like the 2003 or 20% credit offtake also, it can't be ruled out.
So on growth, I think we need to be a bit more cautious. I think we have to take into account the fact that actually part of the loan growth acceleration that we have seen is actually driven by the fact that real rates were negative. We believe by the end of the year, real rates will get into the positive territory as RBI is going to be hiking rates some more, as well as the fact that inflation will come down. But I will also like to point out that the single-digit credit growth that we had seen in the last couple of years, that was actually an outlier. So we have really had this period where credit growth falls below nominal GDP growth. And that was really the misnomer over the last couple of years because there was significant corporate deleveraging that was going on.
Okay. All right, fair. Then we're just correcting an aberration. I'm looking at your ROE forecast for banks. If you look, of course, the highest ROEs are coming still in some of the large private banks, but the delta of ROE is very high in mid-cap banks. See, Bandhan is going from 1% last year to 22%. RBL is going from -1 to 7%. So even if 7% and 6% for IDFC is not high, the delta is high. So do you think that we could see the next leg of rally, catch up in mid-cap banks and even PSUs?
Definitely. I think we saw in many of the larger banks the big credit cost moderation coming last year itself. So 2021 was the year when they had high credit costs, partly due to COVID and buffer provisions. And last year we saw credit cost moderate for them already below 200 basis points. This year, while they still will see a moderation, but the smaller banks who did not see a moderation last year, as they were still building up provision and they had exposure to some segments that high delinquencies like microfinance, they get the benefit this year. Okay. And therefore, the credit cost drop you will see in the mid-sized banks will be larger. And that's what drives the ROE recovery that you highlighted.
Okay. In your buy list, you have, of course, ICICI, IIB, IndusInd. ICICI and SBI are our preferred picks. That's the statement you make. But BOB has started coming into the chatter. Many people have started including it. So is it something that you look at positively? And will more PSU banks catch the fancy of the market?
Sure. So, firstly, that I would not like to discuss specific names, but I can certainly say that across the spectrum, we are seeing banks being cyclical beneficiaries. So it's not going to be restricted to just the private banks or just the larger banks. It will benefit the public sector banks, even the smaller banks. The other thing I would say when we look at public sector banks, particularly the mid-sized banks, one has to be careful about the long-term story and on the aspect on technology. So some of the public sector banks have done well, in fact, matched up to many of the private sector peers in being able to upgrade their technology. But I don't think that is pervasive throughout the mid-sized banks. Okay. And as you know, that is going to be a big driver of business growth over the next 2 years, particularly. So I think we have to be careful in the names we choose, that not just asset quality, but on technology front that they're able to match.
Okay, actually, I'm going to come back to the technology question in just a minute, but perhaps a more interesting question for the market. I know you said you will not talk about specific banks, but I'm surprised HDFC Bank is not on your list. You have a list of buys. I mean, without giving, within your compliance limits, why is it not in your list, and what's your view?
So, actually, I again won't speak of specific names, but I think there are other considerations as well in terms of our compliance. We are restricted on some names, etc. Oh, so sorry, skip this.
That's a pity, because I'm sure there are a lot of viewers wanting to know. But let me come back to the technology question. You know, the recent digital paper that rules that Reserve Bank released, and simultaneously the government announced that it intends to keep UPI free. So you think that this is going to eat into the margins of banks? They have to provide a service and they cannot charge for it.
So I think they clearly have to bear the higher cost of it, but I think we are also starting to see the benefits of it accrue to the banks, right? And benefits not in terms of just costs, because from handling cash you go to digital transaction, but benefits in terms of revenues, right? So across banks, if you, for example, see unsecured lending growth, I think that benefit is a reflection of the fact that banks are getting more comfortable with their customers as they are getting more data about their customers, and that is what instruments like UPI are enabling, right? So I think while there are costs, there are revenues as well.
Okay. Yeah, fair enough. But every banker you meet complains about the extent of technology costs that, is inexorably hitting them. Okay, I began by telling you that in your ROE, delta, the mid-cap banks look, and some of the PSU banks look better than the large established and market favorite private sector banks. But when I look at your data, the contingency buffers, the high margins, the low credit, the low cost of money, it looks like your sympathies are more with larger banks. What would you say? Are mid-cap banks a tactical buy, but larger banks your all-time favorites? How would you distinguish the two?
Yes, so I think there is certainly a lot of alpha there in the mid-cap banks as well. I think, but we also have to be cognizant of the fact that globally we are potentially going to be in an environment of rising rates, right? And that's the risk we need to factor in, that liquidity, which is still in surplus in India. So while RBI has reduced the magnitude of liquidity surplus, we still don't have deficit liquidity, right? And this has been reflected in the fact that while banks have raised deposit rates, the magnitude of deposit rate hikes have been lower than the increase in lending rates. But if, say, 6-9 months from now, the liquidity moves into a deficit and you see sharper deposit cost increases, I think that's a scenario that will favor the larger banks more than the mid-sized banks, who will see a bigger pressure on their funding costs. So I think in terms of the risk profile, the larger banks, I believe, have more sustainable recovery and the potential risk from, although it's not our base case, but a very tight liquidity environment 6 months from now.
Oh, okay, then let me turn the question on its head. I began by asking you that does it feel like the 2003 to 2008 period? And you said that, if anything, you are prepared for upside surprises in your earnings forecasts. You think the run is not so long then, that, the party is perhaps a couple of years in terms of visibility?
So I think we have to look at the stock performance in terms of two aspects. One is earnings and second is multiples, right? So I think earnings is where one can be quite confident on, both on growth in terms of margin and credit cost. I think multiples is something that we need to be cognizant about. And for most matters, the cost of capital for investors is the global cost of capital, right? And I think that is the risk we need to watch out for, that if global cost of capital increases sharply and we get back to scenarios where US long bond yields go up well over 3%, I think that's when the multiple risk starts to come for the banking sector. And that is something that can stimulate the rally.
Okay. Yeah, then we have to wait for the global environment. Okay, I'm warned that I'm running out of time. But let me ask you just one question on NBFCs then. How do they fit into this picture? Are they going to be better than banks? Or would your hot favorites be large banks, which you've already mentioned in your report, and NBFCs follow?
Yeah, so I would prefer banks over NBFCs. I think even in terms of growth, you'll see that banks outpace NBFCs. Yes, NBFCs, like the mid-sized banks, will benefit from the credit cost moderation. But I think most of the banks, including the larger ones, will probably grow faster than most NBFCs still.
Okay, and within NBFCs, is there any preference for the larger ones? Will it be CV makers because, the CV cycle seems to be doing better? Or will it be the personal finance guys? what would since you don't talk stocks, how would you have us lean?
So actually, we like some NBFCs who are vehicle financiers. We also like some personal finance NBFCs. So it's not so much segmental driven within the NBFCs, but more company specific.
Okay. And just the last one, we see a lot of churn happening in the fintech space as well. Will any of them move into your ken as a buy, or are you still more comfortable not having them in your list?
Yeah, so as of now, only a couple of them are listed. So I think we would like to see more fintechs get listed and more kind of business models come up. I definitely feel that many of them have very compelling business propositions. Of course, that has to be measured up against the multiples they are commanding.
Okay, just a final question. There are people going with QIB's banks. Is there enough foreign appetite for the mid-cap banks?
Oh, I think so. I think as people are getting comfortable with the asset quality stability across the sector, as they are getting more confident that growth is getting more broad-based. So it's not just corporate recovery driven, but consumer segments are growing, and as you mentioned, commercial vehicle segments are growing. People are willing to look at lenders who predominate these segments.
Okay, we'll have to leave it at that. Thank you very much, Ashish Gupta, for joining us. So what stays with me is best of breed experts on finance matters saying that if anything, there is an upside risk to earnings upgrades of banks. So that's excellent, especially for the larger banks where he thinks the benefits are greater, more in terms of margins and in terms of the buffers they have. That's it on It's the Economy. We go into a break. There's lots more lined up for you.